Welcome to Subramani. Equity markets have generally been doing well right from 2002 to 2024. If you take a 22-year period in the Indian market, markets have been doing well, make no mistake. Of course, there have been corrections. 2008 is very important for us to realize what happened. There was a global financial crisis. The market went down, but market came up also pretty fast, and dividends never stopped, right? It was not a recession where dividends stopped or a stock market crash where dividends stopped, and for 3-4 years it did nothing, like what happened in say 2004 to 1994 to 2002, right? 2001, 2002. The market was really in a bad shape. Market kept going down and then recovering, then going down further. So it was a huge one-way. It was not a huge one-way thing, but it was a secular bear market. But 2002 to 2024 markets have done well. People have got good returns. Yes, even though we have had challenging periods in 2008, 2009, 2018 and 2020 COVID, 2022 interest rates went up in the US, and so US markets tanked. So which had some impact on India, not too much, thanks to our DIIs and the SIP inflows that we had. So yes, we have had a pretty tough years, but let's say even from 2007, 2008, even though the market went down, I think we've had a good bull run. Most people would have had mid double-digit returns, including dividends. It could even be higher. Having said that, you cannot ignore a report made by Goldman Sachs, which I'm reading out. Goldman Sachs projects the S&P to return just 3% annual over the next decade, which is 3%. The decade is a significant drop from the 13% that the S&P has given in the last decade, right? 2014 to 2024. No, it's not because of Narendra Modi. We are talking of the US market, right? So, of course, Indian markets have also given that kind of a return. So, when Goldman Sachs says there's a 70% probability of getting returns of 3%, I'm very happy with the 70% number, right? Very happy in the sense 70% is a number which I'm more than willing to believe. So if you have retired now in 2014 and you're deploying your money and you think that the market is going to give you good returns, you are in the wrong place. Market returns can go down, and they've given enough reasons, but I do think just catching up with the averages itself means that the market has to go down. Look at the American market. 13% return is what you've got. 11% is the historic return. So just for catching up with 11, it has to still go to 8 or 9. It might go worse. Like Goldman says, it could go down to 3%. So let us look at the key assumption is, I would look at it, if Goldman Sachs is saying 70%, I will not ignore it. I will look at the report. They are saying 72% probability that this can happen, and they are also saying that there is a 30% probability that the market will trail inflation, which means inflation in the US is 4% and equity returns are 3%. That is a possibility that they are talking about. Unfortunately, we don't have such detailed analysis of the Indian market, but you have to be worried about these things, especially when somebody big says that. So the question to ask is, why should the returns be so bad in the US in equity markets? I think it's simply because the markets have run ahead of itself. Obviously, the S&P has too much of a concentration of tech stocks, which is your Apple, your Microsoft, and Nvidia, Meta and all that, right? Historically, I have not seen such a concentrated index. It's almost like the tech index, right? And good chance that Trump would come and look at some of them who have not been very friendly towards him. So those are the things which are scary. And so maybe the returns from Meta from 2012 to 2022 would have been the next percentage, and most of it has already come from 2022 to 2024. So if the say 80% of the returns have been upfronted, the next 8 years the returns have to be bad. In fact, 2024-25 could be great, and after that you could get into negative returns also. So all those, that is one possibility. And I also found that another report by Vanguard says somewhat similar things, and in fact they is saying 3 to 5% annual returns in US, large cap stocks for the next decade. So it also suggests better opportunities might lie somewhere else. So if I were an US investor, what would I do? I would look at other markets, good dividend yield. I would look at gold. I would look at debt instruments. Why would I not look at debt instruments? In fact, for me in gold, which is SGB, and in some gilt, I am getting better returns than what I am expecting to get in equity over the next 2-3 years, simply because the market is run ahead of itself. So JP Morgan says US stocks will return 7.8% over the next 20 years, and bonds will yield about 5%. That is a very huge 2.8% kind of advantage, but this kind of historic advantage has always been there. That still means that the US market has to decline to catch up with the indices even at 7.8%. So the US market declining is more or less given. But having said that, this is the time when Trump is back in action, and some companies would benefit because of that. Definitely the companies which are likely to bleed and be hurt are big tech and pharma. These are not companies which are going to do well. With Robert Kennedy sitting there, pharma is very unlikely to do very well. It might just hold its self, because all these what people say during an election is not what people do after they come to power. So what can you really do? I mean, let's face it, we can't predict the future earnings, we can't predict the future cash flow. But when you are looking at this, I think first of all, if you were an US investor, maybe you would look at real estate. In India, real estate is still in trouble. So, and unfortunately, real estate can't be bought in an SIP. I would be very happy to buy a property in an SIP basis where I don't borrow money, right? So I'm paying the builder in installments per month over the next 5 years. I wouldn't mind doing that. Even if the price were to fluctuate, he does not have to lock into me at today's prices. I wouldn't mind doing that. Unfortunately, real estate can't be bought like that. I will have to do a switch. I will have to sell some equity to buy real estate, or I will have to borrow money to buy real estate, which I don't want to do. So I'll either have to switch or borrow, which both I'm not too keen to do, but I might buy REITs, right? I don't think REITs are attractive, but for me it is just a risk reduction. So diversifying out of your equity portfolio is one good thing, but not too much. Maybe 10% of your portfolio remove and put into some other asset classes which you think will do well. It could be gilt, it could be gold, it could be real estate. It may not be gilt, it may not be gold, it may not be real estate. Let's look at a view on gold. All the countries are buying gold, and therefore gold prices are going up. This is the theory, right? But look at it this way: if Trump comes and stops all the wars, okay, technically possible because they're funding it, the price of gold could go down, saying, oh, now the uncertainty has gone down, so let us sell gold. That's one way. So gold supplies could increase, but major countries buying could also increase the price. So supply could increase, but there could be enough demand. So both the possibilities are there. And for the bigger investors who have a lot more money, could invest in some good AI opportunities, right? So very difficult to do investing in technology, especially for people like me who don't understand anything about technology, nor about the future. So, but yeah, that's not a bad thing to do. Investing in some company, investing abroad, investing in an index which is investing in, say, Taiwan, in Korea, in Japan, and in China, right? So investing in international funds is one good option that you can do if you're in India. And I do think we should be investing only where the odds are in our favor. Odds are not in our favor, we should not be investing. But yes, buying during bad times in the market is not a bad idea. It's a good thing to do. When the odds are in favor, bet big. Right now, odds are not in favor of equity, so I don't think that's something which you should look at. Maybe you should invest in private equity, some venture capital funds. Some of those things could be good. Work harder and longer in your job, earn more money. There is nothing to say that that can't help. If you're doing well in your field, that's good, right? Check out what AI is going to do for your industry, for you. Check out all that. Invest in learning. Make all those investments. I think these are some of the ways to reduce your risk. But reducing your expectation of return from equity markets is a fantastic place to start. Thank you.